If we look back to the last 10, 15 years, the financial markets had an unprecedented growth. Specifically, 10 years after the global financial crisis bottom, the stock market scored one of its best decades in nearly 140 years. Since then, the earnings of the S&P 500 have roughly doubled, and the price has more than tripled. Undoubtedly, the major catalyst for this unprecedented growth was cheap money, because during that period, the highest interest rate was 2.5% back in 2019. So it's been easier and cheaper to access money. And as a result, this has made it easier for businesses to expand, investors to make more money, and valuations to grow. By the end of 2019, it was perceived that whatever one buys, it doubles in no time. So the bubble busted, but this time it was a pandemic. And finally, the historic decade-long run came to an end. Investors' enthusiasm started waning, and they started pulling out their money from the stock market. The pandemic led the world into chaos. Businesses were shut down, and the financial markets collapsed. The recession was dark, and the world of investment was brought to its knees. The central banks across the world started printing money to help their governments cover some of their pandemic-related spendings. Similarly, the US Fed also printed trillions of dollars. And ultimately, the printed money was flooded into the economy in the form of stimulus checks, bailout packages, etc. But the free money couldn't save US citizens. This debt monetization inflated the economy, and the US had to see a 40-year high inflation rate in June of this year. And now, US citizens are living with decades-high inflation, with everything becoming out of reach.
On a year-over-year basis, when you're looking at where inflation is, we thought we could say it peaked last month. It did not. 8.6%. That matches the all-time high in this cycle. And the core rate up 6%.
After inflating the economy, the US Federal Reserve again jumped in and started raising the interest rate. But the consequence of this action is awful. This rise has made it difficult for businesses and citizens to access money. These aggressive moves have halted the economy, with the panic spreading to financial markets. For instance, we saw a free fall in cryptocurrencies. Many big names in the corporate world are struggling, the real estate sector is falling, and the equity market is declining as well. A major sell-off from investors can be seen in the wake of fears that the world is on the brink of a terrible recession. But for the investors, what's the right time to enter into the market? When the markets are already at their peak, or when everything's on sale? In the investors' world, it is a known fact that crashes are the best time to become rich. And usually the crashes occur after a long time. So no one can say with confidence that people will see another time in their life where everything will be on sale. But the question is this the best time to build your wealth? Well, let's dive into the answer about whether this is the right opportunity. And if yes, well, how can one take advantage of this time?
Some people should not own stocks at all because they just get too upset with price fluctuations. If you're going to do dumb things because a stock goes down, you shouldn't own a stock at all.
There is deep psychology involved in investing. The simple idea of investment is to buy low and sell high. However, people do exactly the opposite. They buy high and then sell when it's low. The reality is that they don't mean to do this, but whenever there are tough times, uncertainty and fear scares people and they step out of the markets. But people like the legendary Warren Buffett, Charlie Munger, Monish Pabrai, Guy Spear, Phil Town, and many others say when the market is heavily down, it is the best time to invest. This is an interesting phenomenon. The main reason for this backward psychology is that most people don't seem to have clear investment goals. They usually don't have any commitment to a long-term investment time horizon. Therefore, as soon as things get bad and recession hits, instead of taking advantage of the opportunity, they run away from the short-term chaos. It is a terrible strategy.
We're a net buyer of stocks over time, and who wouldn't rather buy it, at a lower price than a higher price? People are really strange on that. I mean, because most of your listeners are savers, and they should want the stock market to go down. They should want to buy at a lower price, but they have that feeling that they just feel better when stocks are going up.
Let's look at the US's historic bear and bull market since 1926. The bear markets are orange in color, while bull markets are blue. You may see the recessions to be outbarred. It can be seen that since 1926, the US has had 11 bear markets and 15 recessions. If we add the pandemic plunge of 2020, the bear market count would be 12. In cumulative numbers, bear markets lasted for 14.7 years, and bull markets stayed for 75.4 years. But it is a fact that if you had invested during these scary periods, you had been rewarded well. For instance, returns coming out of the Great Depression were around 265% over 4.4 years. Then, people made 43% in 1.8 years, 210% in 4.1 years, and over 900% in 14.8 years, and the trend goes on. People who invested in the biggest bear markets in recent history enjoyed 20 to 50% returns in a matter of 12 months only. Though there is no perfect market to invest, these trends show that these bear markets are great opportunities indeed. For instance, if you had invested at the peak just before the 2020 COVID outbreak, you would have made 9% on your investment. On the other hand, if you had invested at the market lows, which was a few weeks after the peak, you would have made 60%. This is how an entry point creates a difference. However, you must remember that such huge drops are not very frequent. 14.7 years of the bear market, while 75.4 years of the bull market. So it can be concluded that recessions are great opportunities to invest, but how do you seize this opportunity without making mistakes? Well, step 1. Keep up to pace with what's happening in the market so that you know exactly when these opportunities will be there. And step 2, execute your strategy correctly, whether actively or passively, as soon as you see a recession in the market. We all know that there are a couple of ways to do long-term investing. It's either dollar cost averaging or Warren Buffett style, which is long-term value investing. Now, most people go for dollar cost averaging. Now, for those who don't know what is dollar cost averaging, it's taking the money and then diversifying it across the stock market. It's done through something such as investing in index funds, like the S&P 500 index fund, which is, by the way, the largest index fund in the world. Hence, they choose the market tracking investment. And then investors invest the same amount into that market tracking investment fund at regular intervals. It can be $2,000 biannually or something like that, and then your money's split across the whole market. This strategy has been designed to give a long-term reward to the market, which is usually 10% annually for the S&P 500. This strategy does not act like you're timing the market or that you're seizing an opportunity of the market crash. But actually, you're doing that. For instance, $2,000 bought you 12.78 SPY shares on October 9th, 2007. A year later, when the market was on its way to dropping, $2,000 got you 20.5 shares. This is simple. You buy more stocks when they're lower and lesser stocks when they're higher. This is very natural. This is the best way for passive investors to seize the opportunity. Other than this, investors are willing to have more control over their portfolios, and hence, they adopt Warren Buffett's style of purchasing individual companies. They understand that they have a competitive advantage, smart management teams, and enjoy a higher margin of safety prices. We're not going to talk about this strategy, however. We're going to see how active investors ensure that they don't make any mistakes while investing in a turbulent market. The first thing we need to know is what's causing all this to make businesses suffer. Well, at the moment, it's inflation and increasing interest rates. This implies higher costs, reduced spending of consumers, and debt becoming expensive. So now the question is, how do we know if a business will make it through such circumstances? The business you're looking at needs to have pricing power. This means that they've achieved a competitive position. They are capable of raising prices without facing any drop in sales. For instance, many businesses are cutting their prices back since consumers are spending less on discretionary items. On the other hand, businesses such as Coke are strong enough that they can raise the price without suffering a drop in sales. During the inflationary period, with the rise in Coke's prices, they can pass on the cost to the consumers, and they don't suffer. The other factor is rising interest rates. One of the consequences of this is that debt becomes pricier. So to ensure that your business works well during these times, you must see that you have minimal debt. For example, if we look at Google, they have more cash as compared to the debt, having a debt-to-equity ratio of 0.5. They earn more interest as compared to what they pay. Meta is even better at having no debt at all. Peter Lynch says that it becomes harder to go out of business if you owe little or nothing to anyone. Last but not least is the business model. You need to see which business model are you following. Will it be capable of going through a turbulent economy successfully? For instance, grocery stores. Such models outperform during recessions. This is because people can't stop buying essentials. Insurance companies, airplane tickets, etc. All these are things that people can't stop using. Therefore, active investors need to look at the business models, their pricing power, and debt levels. On the other hand, for passive investors, it's all about holding on for a long time and staying strong.